In this video, I want to talk a little bit about gold and silver. There's been a lot of controversial conversation about these two markets and about the metals in general. I've seen both a bunch of commentary on the internet about people saying the gold run is over, and I've seen a lot of people saying that the gold run has just begun. So let's go through and take a look at it from a technical and from a fundamental standpoint and decide for ourselves how this market's going to play out and what we think we should do with gold and silver here coming in the short time future. So the first thing I want to do is this is gold from the futures market. And as you can see, we have a nice little double wave in here. We have this first wave off this total rebound. If we just draw some trend lines in here, let's just start off with the simplest form of technical analysis. And we're going to draw a couple of trend lines in here. We're going to draw the first trend line in here. You can see this blue lights kind of cheat for us and kind of tell us where to draw the trend lines. So we follow those blue lights off of the bulls and bears system. Now we have this market coming into kind of a convergence area. And if we just draw some trend lines across there, you can see that we have kind of a little triangle or a wedge formation coming in here. And then we have the ascending triangle in here. The market breaks out the top of this and starts to rally and has started to create another pattern up in here. We call this a broadening pattern. You draw your trend lines this way, and of course you draw your trend lines this way, and it's kind of coming into what we call a diamond, which is coming down this way, and you can draw your trend lines all over the place, right, and get you these kind of little patterns that we have coming in here. So this is what we call a decision point, all right? And the market's going to make a decision. It's going to either break higher or it's going to break lower. The question is, which direction is it going to go? Now let's come in here and look again at the blue lights. The blue lights are kind of the Elliott wave patterns. If you're familiar with Elliott wave patterns, Elliott's theory is that markets move in waves, 2 steps forward, 1 step back, 2 steps forward, 1 step back, and they do that in 3 drive patterns. And so what we have here is we have this first big drive here, we have the pullback, and then we have the second drive up in here. So you can see the blue lights kind of showing that. And so this is where we're coming into this diamond pattern up in here at the top of this second wave here in gold. Now, Elliott says that markets have a tendency to move in 3 drives. So this would be drive 1, and this would be the neutral, and then another major drive, drive 2. Now, technically speaking, we should get kind of a pullback or a rally and then another projection, right? A drive 3. Now, the reason this is concerning to many technical analysts is because this is coming in here. I want to show you over on the stock market side. Now, this is the futures. I'm going to show you on the stock market side. This is what gold looks like on the ETF in the stock market. It's a little bit more easy to see, I would say. The Elliott wave patterns in here, if we come in here and we just draw them in here, you can see once again, let's just start with our simplest drawing tools. This is our downtrend. This is the breaking of that downtrend. The bulls and bears is changing from bearish to neutral to bullish. And the blue lights are telling us where those Elliott wave patterns are. So we just draw our trend lines where those Elliott wave draws are. So you can see this is our first up wave. We get a break right here between that blue light, which tells us this is the break of the first drive. And then we get a second drive right in here. So this drive right up in here. And we get kind of some of these funny little things when the FOMC spoke and those types of things. So we just kind of ignore those. This is kind of averages, right? And we throw out the highs, we throw out the lows. We get kind of the average of the market. So here we have another break, as you can see, coming in here. With this downtrend, the blue lights broke once again, and then this is our next drive up. Okay, so in this case, on this market, we can definitely see a 3 drive pattern: drive 1, drive 2, drive 3. If we draw our Elliott wave tool in there, we come in here. This is X, 1, 2, 3, 4. And this would be 5 up in here, right? Now we need that blue light to cross over these bars before we get that next break, that A, B, C pattern, right? So an Elliott wave is X, 1, 2, 3, 4, 5, A, B, C. Now we measure these with Fibonacci. This is an Elliott wave pattern, but we use Elliott wave and Fibonacci. It's kind of like hamburgers and French fries. They just go together and you use one with the other. So what we do is we take Fibonacci, and Fibonacci is designed as just a ruler, and all we're doing is we're measuring from the high point to the low point, or in reverse, I guess, from the low point, in this case, from the low point to the high point of the first trend. This pullback came back to around 38.2%. This is the Fibonacci sweet spot down in here. 61.8, of course, is our golden ratio, but this is kind of the sweet spot where markets have a tendency to pull back to. So as this market rallies from X, 1, 2, 3, 4, 5, we're going to measure these. Now we have a saying, buy the valleys and sell the rallies, right? Buy the valleys and sell the rallies. Well, and how do I know when I'm in a valley? Well, this is how we do this. We count and we measure the Elliott wave pattern. So when a market rallies and pulls back into the sweet spot, we know that the market's in a valley. So this is kind of a high probability point of purchase, or this is where you want to be buying the market and looking for the next rally. Sell the rallies, buy the valleys. Sell the rallies and buy the valleys. So this is kind of the name of the game here. So we're going to come through it, and very simple, we're just going to count from the bottom to the top of each one of these trends. So here you can see that the market came in and once again went from the A point down here at the bottom, this pullback, rallied up, pulled back, hit the 61.8% level, started to rally once again. So now we're going to measure the next level. Now this market has come up. It's come from A up to where it's currently trading. We're going to put that right there. It doesn't mean it can't go higher. It certainly can. And but we're just going to measure right now. We're just going to measure from where the current trend is. And the current trend is right here, as you can see at this B point. So from A to B, the pullback would bring us back to 61.8 back in here. Now, doesn't mean it can't go higher. It certainly can, and if it does, we would just drag that B point up higher to match the high point. Now, we're looking for the crossover, that blue light. That blue light is going to indicate when this trend is broken, and we can draw our hard trend line in there as well. Remember, the blue lights are just mathematically calculated trend lines. They're based on the parabolic SAR, and they are hyperbolically linked into the bulls and bears system so that we can use those to help us count and measure these different trends. So this is where we're at with our count and measure of this market. Now, Elliott says that markets have a tendency to go to the fifth wave with 3 drives, and that's what we're seeing here in gold right now very clearly on the stock market side, is that we're seeing 3 drive pattern. Now, again, a market an Elliott wave is just a reoccurring price pattern, and it doesn't mean that the market has to stop at 5. It can definitely go to 6, 7, 8, 9, 10, and I've seen it do that. It's just that the probabilities tell us that more often than not, the market has a tendency to go to the 5th wave before it rebounds and comes back against its position. Okay, and so the Elliott wave theory here is that we don't want to be a buyer at the top of the 5th wave. So this is not a great place to be buying into this market. And the reason is because the probabilities tell us that we need to have some kind of digestion of the previous run. And so the question is, how high is this 5th wave? Where is it going to land? Where is it going to be? If you look at the blue light, we still got quite a bit of time before those markets intercept. And that's going to be the final deciding point, is when that blue light intercepts the market. That's going to be the top of this market, and we're going to look for a rebound. Again, is the rebound going to make the A, B, C retracement back, or is it going to continue and make a 6, 7, 8, 9, 10 high? Again, the probabilities, and that's what we do, and that's what we play here. When we do technical analysis, we play the probabilities, and the probabilities tell us not to be a buyer at the top of a 5th wave. So we're going to be looking for this gold market to be topping out in here and making an A, B, C retracement. Well, how far down do we think it's going to go? Well, this is where Fibonacci comes back in. So we draw from not only a small Fibonacci leg on the Elliott wave pattern, we go to a major Fibonacci wave. We go up to the top of the current market. So from the bottom, the A to the B to the top, and we look for a retracement back somewhere back into this Fibonacci sweet spot once again. So technically speaking, this market is reaching up into the 5th wave of the Elliott wave pattern. We'd look for an ABC top formation, which would also come in there with a head and shoulders. You'd have your left shoulder here. This would be your neckline, your head, your right shoulder here, and then your neckline. And we'd see a trend line coming across there of our neckline of a head and shoulders formation right in here, right? And we would look for the drop and the break below the neckline, bringing us back into the Fibonacci sweet spot, which would be this 50 to 61.8% retracement level. So technically speaking, looking out into the future, we would anticipate that gold would digest this run and come back. Now, we have to talk about gold from another aspect to another sense here, because gold is very seasonal in nature. There's a reason why the market has a tendency to run like this, okay, at this time of year. It's very common. It happens on a regular basis. And that brings me back over to the futures version of the software. We're going to be looking at the futures version of the software. And again, the pattern is just a little bit different over here. It's not quite as defined as the 3-drive pattern over on the stock market. But what we want to look at is the seasonal nature of markets. And we want to take that into consideration, because we have to ask ourselves, why did this market run? And a lot of people will tell you, well, it ran because the stock market is starting to fall. It's starting to cave in, right? And so gold is a safe haven. Everybody's pulling their money out of the stock market and they're throwing it into gold. Well, does that really line up? Let's come back here and look. When did this market start to run? It started to run in May. Well, let's start looking over at the S&P. When is May? May is back in here. May is when this market started to have this big, huge rally in it. So that doesn't really jive, right? People aren't pulling their money out of the stock market and throwing it into gold starting in May. The stock market is rallying and breaking all-time new highs, breaking all-time new highs, breaking all-time new highs. So to say that we're throwing our money into gold as a safe haven doesn't really jive with what's going on with the stock market. Why would be people aren't taking their money out of gold, out of the stock market and throwing it into gold, because the stock market is rising like crazy during the same time gold is rising. So that we have to throw that kind of concept out the window in this particular situation, in this case. So the other question has to be, well, then why did gold rally? If gold is supposed to be a safe haven, but yet it's not corresponding with the stock market falling and gold going up, why then would this market rally like this during this time of year? Again, it's very common. It's a seasonal event that occurs year after year after year. Now, it doesn't happen every single year, but it happens often enough that we can actually chart it. Okay, so I'm going to come down here, and in the lower menu, I'm going to come down and I'm going to turn on the seasonals. Now, the seasonals tells us that markets have a tendency to follow the same patterns over and over and over again, year after year after year. And if you think about in the commodities market, it's very easy to understand this concept, especially with corn, wheat, beans, and soybeans, things like that, okay? We plant them at the same time every year. We harvest them at the same time every year. We bring them to market at the same time of every year. They're susceptible to damage, too much rain, not enough rain at the same time every year. Transportation costs, same time every year. Storage fees, same time every year, right? Very easy to understand in a simple commodity. Well, let's talk about gold. Gold is a commodity, all right? It's a metal. Gold and silver are commodities. And so they have seasonal trends to them. Now, the thing is, you say, well, gold is a perpetually produced commodity. It's not an annually produced commodity like corn, wheat, and beans. We bring gold out of the ground all year long. So that doesn't really, account for gold's rally at this time of the year either. What does? Well, gold is no longer used in industry. It's just too expensive. We really use gold more as a currency nowadays as anything else. But there is one place where gold is used, and that's jewelry. All right, it's about the only place that we actually make and use gold products anymore, and that's jewelry. And when do we spend and sell and buy the most jewelry? Christmas time. Right? Christmas time. And so what we're seeing here is a phenomenon known as the seasonal nature of gold as the gold wholesalers. Now remember, these are the wholesalers we're tracking here in the futures market, not the retailers. Retail would be back out into the December timeframe. October, November, December is when these products have to be on the shelves ready for people to buy them. So the wholesalers are actually starting to buy up the gold and getting ready to manufacture or create the gold items, the jewelry that's going to be sold for Christmas. And this is called the Christmas rush, or the Christmas purchase of gold. And that's what we see here. This seasonal trend, or this seasonal chart, is, as you can see, if we come over here to the seasonal settings, is a 10 and a 15-year seasonal average. Now, this is not a price average. This is a seasonal this is a trend average. It's based on a 0 to 100 scale. But you can see that this is where the market has a tendency to run over the last 10 years, and the red line is the last 15 years. So the 15-year line is is where the market has gone over the last 15 years. The blue, this with the blue background, is the last 10 years. And so we generally see this over this time of year. It's something we look for and anticipate and wait for every year. We love the gold trade because it is something that we can look forward to. It's charted. It's very well documented that this is something that generally occurs. Now, you can see it happened a little early this year. We generally see the run start out here in June for the December contract, and it then generally peaks out here in September. We then have a little lull and then another small rally as they pick up the rest of the gold depending on how much the orders are, and then it drifts off into expiration out into December because they're no longer purchasing the gold. It's already been done. And the price of gold starts to decrease going into expiration of the December contract. So this is what this is. This is kind of a combination of a number of things, I believe, but primarily it's the gold buyers buying up the gold, getting ready for our holiday season, and this is again something we look for every year. Now, this is starting to come to a peak up in here. It came in a little early this year. They started buying a little early. Generally, we don't see them start buying until mid-July. They started buying quite hard here in May 31st. Now, that may have been some other things that caused this to occur. This may be the buying season for gold right in here, but we do see it peak out in here somewhere around September 11th. Around September, you can see that's the peak right there, September 10, 11, 12. Right in here, it starts to peak out, and then it starts to drop. Now, is it going to correspond exactly with September 10th, September 11th out here? Is that where we're going to see gold drop? Maybe not this year, because it's been off a little bit. You know, these years shift a little bit. Gold is not the only one that shifts a little bit back and forth. These are, again, averages. If you think about corn, wheat, and soybeans, again, it's really easy to think about those because, if there's too much rain like there was this year, it's difficult for the farmers to get into the field, so they may be delayed 2 or 3 or 4 weeks, and then that's going to offset the seasonal balance for this year, and prices are going to be off by 2 or 3 weeks in how they react to what's going on throughout the traditional year. And that's going to be the same thing that's happening here in gold. We may be getting this little run a little bit, coming in a little bit early, but nonetheless we're getting this. This is kind of what we're seeing right in here, the seasonal run that we anticipate each and every year. And we also anticipate this little ABC top formation and a drift lower into expiration. Now, where this is all coming together and where this is important to know and understand is we don't want to be a buyer at the top of the fifth wave. If we come back over to the stock market version, you can see that we're definitely in a fifth wave. How much higher this can go, how much longer it's going to last is anybody's guess. And you can, if you want to take long positions at this point, you'd want to do it very cautiously, very carefully, because there is the definite technical analysis here saying that we're getting up and reaching up into that fifth wave. There's the fundamentals over here on the seasonals that are telling us that we're reaching or approaching in this top of this seasonal pattern. And the only thing that we have going for a longer term trend is the fact that over here on the futures market, we definitely have some a less clear view from an Elliott Wave standpoint of a 3-drive pattern. This seems to me over here to be a solid 2-drive pattern, but we could definitely get that next drive. We could get the ABC pattern in here, ABC, the pullback, and then one more rally for that third hard drive going up into this seasonal peak. But this is right here a very dangerous place to be taking a strong long position, in my opinion. Okay, now again, there are a number of pundits and a number of TV special angelists who are out there saying that gold is going to go to the moon. And there are those who are saying that the gold run is over and that it's going to fall. So how would we trade this? How could we trade this? Let's come over here to the stock market version very quickly. And I'm going to show you a strategy that I've put on here for you. Very simple, very easy. And it protects you to both sides. And I'm going to come in here. I've already put it on. I'm just going to turn it on here for you. It's called an iron butterfly. Now, an iron butterfly is kind of a complicated, but not really. If you think about it, it's not really that complicated. It's kind of a complicated option strategy, but not that bad. If you just think about it in pieces, then it's not so hard to understand. Let's think about it, just these two options here, first of all. Let's not think about these options out here. We're just thinking about these two. Now, these two options are nothing more than just a couple of options that we sold and collect the premium on. Okay, so if you see over here, if we take this box, you can see where I'm drawing over here. We received for the first one, this is a $260 option. We only did 5 of them. We're not taking big, huge risks. We're not doing 20, 50, 100 options. We're doing 5. Okay, so it's a kind of an easy strategy for a small account if this is something that you want to do. So we're going to sell 5 calls and we're going to sell 5 puts. Now, very easily, you can see that those expire in 30 days. Now, we know that the options delta or the options theta actually decays very quickly in the last 30 days of an option. So this market doesn't have to move very far or move at all is what we'd really like to see happen. And these options will decay, all right? They will slowly decay and you'll collect your 260 on the top side and 185 on the bottom side. Okay, so that's what we're doing. We're just selling to collect premium. Now, what if the market does take off? What if it runs like a mad dog? Well, we don't want to be sitting, we don't want to be holding that bag, all right, because that's very dangerous, selling what we call naked options. Naked meaning that they're not covered or protected with an insurance policy. So now, instead of just looking at the center options, let's look at the outside ones one at a time. So this here, we're selling this option here to collect the premium, and the premium we're collecting is $260. Well, with that $260, we're going to come up here and we're going to buy a call option. And we're not going to buy just one, we're going to buy 5, which matches up with the number we sold, and of course that's $260. So we're going to pay $260 for the call options, the 5 call options, and we're going to receive $260 for the options that we sold. Okay, so we just look at that one left wing up in there, that one little strategy. And then to the downside, we just look at these two all by themselves. Okay, no big deal, very simple. We come in here. We sold this when we sold 5, and we collected $185. And now we're just going to buy 5 out here as our insurance policy in case the market drops hard. Or we're going to protect ourselves to the downside, and that's costing us $170. So as you can see, it's a very neutral position. We're using the credits from the options that we sold to buy the options out here on the outside wings. Okay, now the difference here is, notice the time frame. The options that we sold, the 2 center options, have 30 days until expiration, but the options that we bought, they have longer time frames, 58 days till expiration, and this one down here, 58 days to expiration. And so as you can see, the outside wings are actually a better opportunity to collect additional premium as the markets either increase in value or decrease in value, and being paid for by the options that we sold. All right, so that's a nice protected strategy. It's called a condor, and you can put those on very safely in a situation like this where we're at a decision point and we don't know if the market's going to continue to rally higher. If it does, we're going to have a call option up there paid for by the sale of this option to help us buy the one that we're looking to profit from on the upside, or vice versa, we're going to look and go to the downside. Now, if the market does make a decisive move one direction or the other, and we have no question that it's going to continue in that direction and not go through kind of a wave pattern or a sideways pattern, we can liquidate the opposing options and let the other options on the other side, whether long or short, continue to run. That's what we call cut our losers short and let our winners run. And if you've enjoyed this video, I'd look forward to a little bit of feedback. Feel free to send me an email, lhturner@tradementors.com. I'd love to hear from you. Swing by our website, www.tradementors.com, and we'd love to have you sign up if you'd like to have more information about how you too can trade options like this.